welcome back to Money Talks. I'm Mia Lee, escort, stripper, CPA, and recovered banker. Today we're going to talk about foreign investments and global diversification. Let's start with US indices. When we invest in US indices, it's actually like opening a door to the entire world, not just the American market. Consider owning shares in a giant like Apple. The company doesn't just make sales in the United States. It's a global powerhouse. Its products, from iPhones to MacBooks, permeate every corner of the world. When you invest in Apple, you're not just betting on American innovation, but on global consumption and technological adoption. The same goes for a company like Coca-Cola, a brand that's synonymous with soft drinks worldwide. Every can of Coke or Coke products sold, whether it's in the bustling streets of Tokyo or in a quiet neighborhood in Cairo, contributes to the company's global sales, affecting its stock price and, by extension, the value of the US indices that it's a part of. Diversification in investments internationally can help you build a really well-rounded portfolio through a mix of assets from different sectors and regions. By looking beyond US borders, you're not just diversifying, you're insulating your portfolio against the volatility of US markets alone. Every country or region reacts differently to economic events. Much like we saw during COVID, and now with Ukraine and Taiwan, you're less likely to feel the brunt of a downturn in any single market if you're properly diversified. No two countries are the same. Each is influenced by demographics, resources, and geopolitical dynamics. Emerging markets might offer rapid growth potential thanks to a young population and increase in consumer spending, while on the other hand, developed markets may provide stability and security. Understanding the macroeconomic factors is crucial. They shape market trends, influence currency values, and affect overall investment returns. Currency fluctuations are going to add another layer of complexity to this. A strengthening currency in a country where you've invested can amplify your returns when converted back to US dollars, adding an unexpected boost to your international holdings. On the flip side to that, a strengthening US dollar is going to corrode your returns of a foreign investment. This is the part where I'm going to plug my favorite company ever, which is Vanguard, for their low-cost ETFs. Vanguard ETFs, with their low fees, broad diversification, and liquidity, are a really excellent vehicle for those looking to diversify internationally. I'll give you a few examples. Vanguard's Total International Stock ETF, ticker VXUS, for example, is a ticket to the global theater. It offers exposure to over 6,000 non-US stocks. Similarly, the Vanguard Total International Bond ETF, ticker BNDX, diversifies your holding across global bond markets, providing a cushion and steady income stream from over 4,500 foreign debt instruments. For those of you with specific investment interests like real estate or dividends, there are ETFs like the Vanguard Global X-US Real Estate ETF, ticker VNQI, and the Vanguard International Dividend Appreciation ETF, ticker VIGI. These specialized ETFs allow investors to focus on particular sectors or investment strategies like dividend growth while still enjoying the benefits of international diversification. With all of that information, let me give you my personal take. I predominantly have kept my own portfolio US-centric because I believe that I already have sufficient diversification and exposure to other countries through US indices by owning companies like Apple and Coca-Cola. One significant trend that's challenging conventional wisdom is the concept of deglobalization. We've had decades where things have become cheaper and more intertwined, facilitated by organizations like the WTO or World Trade Organization and NAFTA, the North American Free Trade Agreement, and from my own roots in China, their Silk Road Initiative. But now we're seeing trade wars and tighter borders. We're hearing about tariffs. I first started taking this seriously when the UK left EU during Brexit. When reflecting on many of the largest global trends from the past decade that were touted as transformative regions, it's really clear that the narratives often outshine the actual investments and investment returns. Those who were enthusiastic about BRIC countries are now reassessing. The BRIC stands for Brazil, Russia, India, and China. Given that two of the big components of BRIC countries are Russia and China, with current events, it's really evident that leaders like Putin and Xi are complicating investment opportunities in their region. I myself was working at a private equity fund with a large focus on Russian investments when Russia invaded Crimea the first time before Ukraine. And there were all these sanctions dropping literally by the hour. And one of my jobs at this private equity fund was to wire $30 million to Russia while sanctions were being updated on an hourly basis. You can imagine what a great, or not great time really, I had talking with our banks and trying to send this behemoth amount of money to make a Russian investment during a Russian invasion of a sovereign nation. There's been a narrative change. Everyone was hyping up China's growing middle class and the whole e-commerce explosion for the past decade, but let's be real. If you're a US investor and you put your money into Chinese companies like Tencent and Alibaba, you've had a really dicey ride the last decade. And similarly, if you really believed in Hong Kong and its economic growth, well, then maybe you bought the entire Hang Seng index. That hasn't really budged since 2000. It particularly took a nosedive after COVID because of the relations between Hong Kong and China and the geopolitical complications there. The new hype is all about India. Kind of like how everyone was all about China back in the day, India's got this massive young population of over 1 billion people. Most of them speak English because of British colonization. And I've got to be straight with you, diving into investing in India isn't so straightforward because figuring out the real deal with the finances of these big Indian companies can be really, really tricky. Now we're also hearing similar stories about Mexico and Vietnam, with countries like the US talking about nearshoring and bringing their manufacturing closer to home. It's definitely something to watch, but it's tough to say what is actually going to happen and what's actually going to pan out. Here's the bottom line. We're always going to hear these kinds of stories promising the next big investment opportunity in the next hot region. But honestly, figuring out what the future holds isn't easy unless you've got the inside scoop with respect to geopolitical risk. While it's exciting to think about, remember that you need to tread carefully and do your homework before diving into global investments. That's all I've got for you today. Thank you so much for listening. I'm Mia Lee. You can take the girl off Wall Street, but you can't take the banker out of the whore. Drop me your comments, questions, and suggestions for future content.